Welcome to Bar Charts Market on Close. I'm your host, John Rowland, Bar Charts Senior Market Strategist. Markets are hitting all-time highs on Free Slurpee Day, so grab your sweet treat while Nvidia melts past $4 trillion in this scorching rally. The dollar's so cheap you can't even buy shade from those hot temperatures. Can copper be more precious than gold? And when is a cup with a handle more powerful than a head on a shoulder? All these plus your questions, and to help me out with today's show is Mr. X, Twitter Tom. Hello, Thomas.
Hello, John. How are you?
I had a nice week this week. A couple of the trades we've mentioned in the past have done really. I know we did a segment on value stocks. We looked at Levi. Levi had a great earnings report. I know that we've talked about materials in the past. We're going to do that again. And MP was one of those stocks that we look at, and that stock went rallying up when the defense says they're going to buy it. So it was a good week for your buddy here, bro. And I know you had a good week because Bitcoin made an all-time high. So
Bitcoin made an all-time high, and Nvidia is shooting up like a rocket. I mean, if you were bullish, John, this is a pretty good week, and I can't imagine too many people are upset.
No, I don't. I can't even.
Except for the Bears. The Bears are in tears, but everybody else is doing well.
Back in the woods.
All right. Just a reminder for everyone watching directly on our website. If you want to ask a question, just click Ask a Question at the top right. You'll see it in the orange color. If you're watching on YouTube, go ahead and ask those questions directly in the chat. John and I will get to as many as possible. All right, John. So obviously, market is hitting all-time highs. Bulls are celebrating. They're going to be the toast of the town this weekend. Bears, unfortunately, have crawled into the fetal position, which is unfortunate for them. But they were warned. We gave them plenty of warnings that things were looking good. But we're kind of in an awkward position, in my opinion, John, because next week, now a lot of people know July is strong, but next week is actually the strongest week of the year for the S&P 500. That's based on historical numbers going back to 1985. But I noticed this, John, which is a chart about the Bollinger Bands. And as you can see, the S&P 500 traded above its upper Bollinger Band, John, for the past 8 days. This was a few days ago, guys. Last time I did that, John, was in July 2024. S&P promptly dropped about 10% after that. So does it feel to you, John, like the market is running on fumes at this point, or do you think there's still a little bit of energy left to kick it up even higher?
Well, I think this is a good point. You know how much I love Bollinger Bands, and we're going to look at this in a second. But let's go back to remember what we talked about a couple of weeks ago with let me change my chart here. This idea that there's just characteristics that happen in the post V bottoms. And that the one was that once you break all-time highs, that you get this slow, methodical rally that takes you to new extremes. And the second characteristic is, and I think this is what you're kind of hinting towards, is that after establishing a new high, there's a high probability that the market will come back and retest, those old all-time highs. And so that's what I think we're kind of setting up for. So let's see if we can find the evidence for that. But, again, the market right now is doing that characteristic that we see post-V rallies, and that is that strong bull markets never convince you to buy them. They just creep along. But yeah, I think there are some things that we need to look at. So let's look at, for instance, some momentum indicators. Here's our RSI up here. Here's our RSI up here in our MACD. And let me get rid of this here so we can get a little bit more space. What I do see here is that we're getting a bit of a negative divergence, and that's never really a good sign. And the other thing is, from experience, I know that when you get one negative diversion and then you get a second negative diversion, that's usually a little bit more an ominous a sign. But that doesn't mean that we're going to get a crash in the market. It just means that, the momentum is slowing and that we could see some type of mean reversion. And that is exactly what, you were kind of talking about. Now, I want to kind of show you guys a new feature that we have And we brought this up in new technical analysis, and you can put these on your custom view pages. Is you can now look at Bollinger Bands in a percentage based on where it falls inside of the band, and you can see for the S&P right now, we're at 78% above the mid. Now, what also is really cool about this one is, remember, I just showed you the momentum on the RSI. It tells you here that in terms of RSI ranking, we just made a new below 70. And those who are use RSI know 70 is kind of that guideline of what could be overbought conditions or oversold conditions, 70 and 30. And so when you go above and then you go below, that tends to be a signal that you have waning momentum. This is a kind of cool little tool that we're gonna feature this as more and more as we go later on in the summer. But let's look at the chart again. Let's go back to the chart here, and let's go back to Bollinger Bands. And again, so this is what we're kind of looking at. And I'm not concerned, Thomas, here's our old high. So it's above, our old high is above our mean. Now, typically what you happen is that you have two things that happens once you go outside the Bollinger Bands. Have you been carrying it along, like you said? Either you have a snap back to the mean, or you can travel sideways while the mean catches up. And I think that's probably what we're going to see during this next week, right? This kind of this slow, methodical sideways but upward movement. So I think that's what we're going to what we should look for. Now, in terms of a correction, right? A 10% correction, like what you were talking about, would put you on the lower Bollinger Band. And again, that would be that retest of the highs. Now, probably wouldn't want to see that, but I don't still think that would be a bad scenario, especially if you look at this from a weekly scenario where, we are getting close to the outer band, which could be that sign that we've gotten as much as we can out of this rally. But, again, if we think about in the upper quartile of Bollinger Bands, even a pullback into, let's say, the daily outer band, lower band, or to the all-time highs would still be in that upper quartile on the weekly. So I still think that would be bullish for the S&P. What I like to see is, and again, one of the things that we've talked about, I guess ad nauseum, is that I want to see leadership. I want to see who the leadership is. And what I've seen here is that we've moved away from technicals and cyclicals like consumer services and discretionaries, and we're moving more towards that next phase or that next rotation of market psychology, so to speak, which I've shared this chart with you guys before, is, as we move from a bottoming to a bull market, when we move from technicals and cyclicals, we start seeing that industrials and basic materials are performing. And I sent this to Thomas yesterday. Is here we're looking at the S&P 11 sectors, and you can see here on the materials, those stocks that are in the material sector, 92 of them are above the 50-day moving average. But Thomas, what was it yesterday?
Below, right?
No, it was 100%. Remember?
No, I don't. You threw me for a loop on that one, John.
I sent you that video or that snapshot. But yesterday, yeah, all the stocks in the material sector were above the 50-day moving average. So we're seeing leadership move from the tech and the cyclicals to the industrials and the materials. And if we've looked at this page before, and I can think maybe like 6 weeks, 8 weeks ago, there was a lot of red on this page, and now we see a lot of green. There are there's some weakness in the market, but overall, I think we can make a strong case that the breadth is widening here, and I think that's a good sign for the market.
All right, so John, something else I've been watching this week, and something I don't watch a ton, but it just really jumped out at me, and that was copper. And copper, obviously, we've talked about metals before. Metals have just been going nuts. But copper in particular, John, went crazy. 13% move. I called it a God candle because if you look at the chart, it just really jumps out at you, John. Guys, this is the biggest daily gain in history for copper. John, what is your takeaway from this incredible bullish move by something we often refer to as Dr. Copper?
Yeah. Well, this was based on the idea that the current administration is going to add a 50% tariff to copper. And, Thomas, to me, this does not make sense to me because if you think about it, why would you want to tax the most critical input resource to all these industries that you want, American exceptionalism, right? Data centers and, infrastructure build out, construction. I mean, the list goes on. How many things that we use copper? It just doesn't make sense. It's like saying drill, baby, drill. Oh, by the way, while we're waiting for the drill, baby, drill, we're going to add, a $2 tax on gasoline. To me, it just doesn't make sense. But from that standpoint, I still think that there's a lot of positives for copper. So let's go to look at Freeport-McMoRan. And then while we're looking at Freeport-McMoRan, I have the chart here. I just want to give you a couple stats here. I think this is kind of amazing. And this is kind of to my point. Forecast demands for copper from data centers alone is going to be an increase of 1.2 million tons by 2029. Now, to put that in perspective, the U.S. consumes 1.7 million tons a year. The average new house has 440 pounds of copper in it. That's in wiring, plumbing, and appliances. Now, our U.S. consumption of about 1.7 million tons, it only represents 7% of the global demand. Now, currently, copper prices, like what you showed in that chart there, currently in the U.S., copper prices are bringing a 30% premium over the London Metal Exchange, which is really kind of the global price. And I think that what is effective is front loading people who are buying copper now in before the expected tariffs. So there might be a little froth in the market, but let's talk about Freeport-McMoRan and what we might take away from this. First of all, Freeport-McMoRan represents 74% of their revenues is represented by their copper. The other rest is some other metals, mostly gold. 47% of their production comes from the U.S., 30% from Chile, and 23% from Indonesia. Now, they also own or control about 70% of the U.S. smelting capacity. Now, that only represents about 5% of the global smelting capacity. So, major player in the U.S., kind of a minor player worldwide. So let's take that into consideration. Let's say the market's a little bit frothy, but the demographics and the mega trends behind the price of copper, their tailwinds are not going to go away. They're going to remain strong. So let's look for a trading opportunity in Freeport-McMoRan. Now, it's already moved quite a lot from its most recent lows, but what I see here, Thomas, is again that V bottom that we've talked about many times before, and those characteristics. So, one of the rules we learned from V bottoms is you can measure the depth of the trough, and then you can extrapolate that into a future price. So this would be, let's say, our middle line would be around this 43.90 level, and there's our trough, and then we could extrapolate it up to about 69.50. Now, I'm not saying that's where we're going to go, but that's the theory behind V bottoms. So 40 to me, again, look at 40 here. This looks like a very critical level, how the market kind of likes this level. It holds it, and then it falls below it, and then it rallies above it, and then holds it, then falls below it. So 40 to me seems like a very critical level. So there's a couple of trades we could do here. So the one that I was kind of thinking about, and again, the froth in the market doesn't mean that I'm going to jump right into this, but I'm going to just show you what I'm watching and what I'm planning. So I'm going to go to vertical spreads here, and I'm going to go out. Anytime I buy a credit spread, I always want to give myself a lot of time. And so, current price, again, maybe a little frothy for Freeport McMoRan, but we saw our most recent highs around that 52 level, and our target is somewhere around 62 level. So I notice here that we got a 45-55 call spread. Now, typically when I do these call spreads, I like to have 1 unit of risk for 2 units of reward. That's kind of just my guidelines, and we're pretty close to that. Not necessarily there, but we're going to risk $3.70 to make $6.30. Again, maybe I might wait a couple days or a week. We got earnings in 2 weeks. Maybe this is a post earnings trade, because I believe this is a longer term picture, and this is not a short term momentum type thing. But, let's think about this. Something we used to call the Texas wedge on the floor, Thomas. And so if I believe in this story, this 45-55 call spread story, and I'm going to pay $3.70, but let's think about that $40 value. And so here's a naked put. Now you have to have the capital to help you margin this again, and you also really got to have the belief that the stock is going to go higher, or that you're willing to buy Freeport McMoRan at $40 in case the market does fall. But look at a $40 put. Is now the bid here is $1.76. Now we're still trading here. We still got only 15 minutes or so, but you can see that the put last just traded today at 185. And if I look at the prices today for this particular put, let's see, I don't have my highs and lows up. Oh, here, highs and lows on it. It got very close to $2. So again, timing wise, if I could sell a $40 put for $2, and I collect that premium and I put that towards that $3.70 debit that I'm going to put on this $10 credit spread, well, now my cost is only $1.70, and that makes them for a much better risk to reward. Now, Thomas, I think what I would really like to see on this trade is that, we get that price appreciation between now and December, where we don't get above $55. I exercise the $45 put, collect all that premium on the call, exercise the call, collect all the premium on the put. And then what I would do from there is I would continue to roll or keep selling that target price, that 62.50 covered call, and try to create income on the stock that I believe is going to go higher. So that's something that we're going to watch over the next couple of weeks. And this is a trade that I'm planning. I just haven't executed it yet.
All right, John. So I teased our next segment as the untapped investment opportunity everybody's overlooking, myself more than anyone, John, because you have been trying to get us to do this segment for a while now.
Yeah.
But it's not something I know anything about. It's something I've never really even taken a look at in terms of trading opportunity. So, John, tell me why I should care, and tell me why everybody else should be interested in this.
Yeah. So what I was wanting to talk about in the energy space is that refinery margins are starting to really get strong again, and this is a good thing for the refiners. So inside, I just have the crude oil market up here, but under the FX, if you go in here, you can find popular spreads. And what we're looking at is called a crack spread, which is called the refiner's margin. And it basically tells you how much the premium that they're going to get for the refined products that they're going to make from crude oil, right? Crude oil prices, right? We don't use crude oil, right? We refine crude oil into these products. And so typically this time of year, it's gasoline is really the driver. But what we've noticed is that it's heating oil or diesel is really starting to drive the U.S. market. And now why is that? Well, first of all, we are about 23% below 5-year averages in terms of inventory. And global stocks are at multi-year lows as well. So U.S. production of heating oil, about a third of it goes to Europe. And so what we're seeing here is this kind of a very direct correlation and demand picture. not only here domestically, but also in Europe, which is taking a lot of our heating oil. So we're heading into a strong actual heating oil season. I know that's kind of opposite of what you think, but you get a lot of highway construction during this time of year. We were moving into the ag harvest season, and then up until about October and November, you get some pre-winter sales. So I think this is something I wanted to talk about in terms of a trading opportunity. And maybe we might miss it, but I don't think so. I think this is going to continue. So here's Valero. I just want to show you how well Valero looks. Again, this is a weekly chart. Again, a lot of these charts look very similar to a lot of things that we've been watching. Here's Marathon again, another large refiner. Again, their chart looks pretty decent here in terms on the weekly basis. But here's this kind of is this like the little brother or the third largest refiner in the United States? So that's Phillips 66. And this is what I was hinting on the opening, is you got this little bit of this inverted head and shoulder. You can see it right here. And then inside the head and shoulder, think about this right shoulder, we have a bit of a cup and handle. And this is what I call fractalization, or in other words, when we start seeing multiple chart patterns inside of multiple time frames. And if I went down to a lower time frame, let's say a 30-minute time frame, you would really see this cup and handle, right? You can really kind of see that it's very, very obvious to me. So again, I don't think this is a FOMO type trade. I think there's a lot of momentum in this trade. A lot of momentum has already taken this trade, but again, I think maybe look for a little bit of a pullback, maybe a down day in crude oil prices, or watch the dollar index. When the dollar has a big up day, that will have an inverse reaction to these refined products, and that might be an opportunity to buy these refiners on one of those dips.
All right, John, I feel like this next topic is something people are talking about more than at any point in my lifetime, and that is the U.S. dollar index. Now, we've covered this a little bit in the past. People are wondering where it's going, John. We got one people who think the dollar is finished and it's going to zero. We've got another group who think it's going to go higher for sort of a reversion trade. I am slowly getting into the camp where I think it's at or extremely close to a bottom, John, and there's three reasons. One is I've seen evidence, data to support the idea that the short side of the dollar is a very crowded trade, John. And when everybody is on one side, I personally like to go on the other side. The second reason is a death cross. So we have, and this is on the weekly chart, guys. So we have an upcoming death cross on the weekly, John. So that's when the 50-week moving average crosses below the 200-week. Last time this happened was 2021, and the time before that was 2018. So it's a pretty rare occurrence, John. But as you can see, the last two actually exactly marked the bottom, and then it was followed by a huge upside reversal. So that caught my attention. The third reason, John, is this trend line. Now, some people aren't believers in trend lines, John. I may not be a huge believer in a trend line, but this one is a 15-year trend line. And each time the dollar index has tested the bottom trend line, it has marked the bottom. It feels compelling to me, John. What say you?
Well, let me see if I can give you evidence to support your argument. So let me pull up my chart here for a second, if you can. So again, you know how I love Bollinger Bands, but we drew these lines the last time we talked about the dollars. We said the dollar looked like it was going to break below 100, and where did we think there was a demand zone? And you can kind of see where we drew a potential demand zone. Now, the Bollinger Bands, these are weekly Bollinger Bands. This is the time frame you were doing your analysis, does support that we could see lower levels, right? And that would fall inside of this demand zone. So, we're kind of right on the edge of it. So yeah, there is room for the dollar to go down. But here's the thing about the dollar index is a lot of people don't realize this, or they forget about this, that the dollar index is really 57% the euro. And, um, so what we're really looking at here is the relationship of the dollar versus the euro. So here, this is a weekly chart, euro dollar, euro being more expensive than the dollar currently. And what we can see is there's your 15-year trend, right? There's your 15-year trend of the dollar strength, weakening euro. Now, we could say that there's been a change of characteristics here of recent where, we've made a low and then a higher low. But in the big picture, yeah, we've probably broken out. Maybe we're in a sideways, but we're coming up against a level of resistance, or in other words, a supply zone in the euro, resistance in the euro, support in the dollar. So again, I think there's room for the dollar to go a little bit lower, but I'm in your camp. I think this is probably a very short-lived trade, and that probably what we're going to see is the market will probably come back. Now think about it. If this is a breakout of this channel, there's probably a higher probability that at some point we'll come back and test that channel somewhere around here, which would be the middle of this kind of channel. So I agree with you. I think this has been a crowded trade. There is potential for that we're up against resistance. And when we think about Forex, and this is really the basis of Forex, is the carry, the overnight interest rate. And we still have a higher, I don't care how you slice it, we still have a higher carry interest rate than the euro.
Well, selfishly, John, I really want to see the euro tumble here because I am headed to Europe end of this month. And John, it's super annoying because I booked my hotels months ago, but the hotels haven't charged me. They're waiting. So I'm really getting taken to the cleaners right now, John. I need things to turn around quickly.
So in other words, you're long this trade, right?
Yeah, not by choice. All right. Let's get to our last topic, John. It's actually one of my favorite assets. It's my favorite stock, and that is, of course, Nvidia, making history, John. The first company to ever hit a 4 trillion market cap. 20 years ago, John, if you told me a company was worth 4 trillion, I would have asked you for an explanation because I wouldn't be sure what was going on. But with all the money out there, anything is possible today. And this kind of caught my attention, John. Nvidia is now worth more than all of Germany plus about $1 trillion, John. So they got about $1 trillion left over as spare change. This just puts into context, just I think some of the craziness going on in the markets, John. What do you think about this?
Yeah, I think there's some positives to this, and I think there's some negatives to this. And let me throw a stat right on top of you: is that Nvidia represents 7.5% of the market cap of the entire S&P. Barron's actually had an article, I think it was today or yesterday, came out and said that of 494 S&P stocks, the market valuation is $35 trillion, which means it's about $71 billion per stock. If you take the 6 megas, the largest caps, it's 40 times greater. In other words, their value is about 2 trillion. So this is one of those, I think this is the negative, is that we see this high concentration in just a few stocks. But and the idea though here is, and this I think this is really amazing, is that Nvidia was only $1 trillion company about 2 years ago. Meanwhile, it was the fastest company to $1 trillion, and we've quadrupled in 2 years' time. We can see this; it's up 1,400%. So my question to you, Tom, is I know this is one of your largest holdings. Are you adding to your position? Are you doing some portfolio rebalancing? And do you have any concerns that maybe this stock is gotten way ahead of itself?
Well, Nvidia is my largest equity position. I'm a huge believer in the company. I'm a huge believer in its leader, Jensen Huang. I think he's one of the smartest guys in the world. I've trimmed a very, very tiny bit, John, here in the 150s and 160s. That being said, it's still my biggest holding by quite a large margin. I'm not concerned. I do think Nvidia is the company that is, if any company can rule the world over the next, let's say, couple decades, John, I think it's going to be Nvidia. So yes, the 4 trillion market caps kind of shocks me to my core, right? Based on historical precedents. But I think with all the money out there, I think with the potential of AI, I mean, every day I'm reading some sort of crazy story about countries utilizing NVIDIA's technology in different ways, John, that maybe you didn't even think was possible the day before. I keep seeing those stories, John. It just makes me even a bigger believer in NVIDIA's potential over the next, let's say, 20 to 30 years. So,
Yeah, you said something about that Russia's using their chips in drones or something. Imagine,
yeah,
you blow up a drone, and a $10,000 Nvidia chip at the same time.
right.
And certainly they are in the center of a multi-year AI expansion. So I agree with you. But here's just for some funs, like, shits and giggles here, is Nvidia moves. Most stocks move about 1 to 1.5% on any given day. So a 1.5% move in Nvidia represents between 65 and $75 billion in market cap. And I just want to show you this, Thomas. Put this up here. Is I used our screener, and that's all I'm doing is I'm screening stocks between 65 and $75 billion. And look at some of these names. In other words, Nvidia on a daily range movement moves the market cap value of like a New York Mellon or Colgate or even our friend Freeport McNamara. Um, so I just think this is almost mind-boggling to me that one stock has gotten so huge. Like you said, it's greater than the economy of Germany, but it's also on just a daily basis. It's throwing around numbers that equal, the market caps of some of these very, I mean, well established and I would consider huge companies too.
I before we get to everybody's questions, I'll leave my parting thought on Nvidia, which is this: the trend is your friend. Do not fight the tape.
Until the bend at the end, right? But to me, here's my party thought is everything looks bright and shiny for Nvidia, and one of my favorite lyrics is that just when you think you're on easy street, danger is at your door. So I'll leave it at that.
Well, if danger comes a knocking, I'm not going to answer that. I'm not going to answer that door, John.
You're staying in the basement.
All right, John, I'm going to do one question here, real quick, because it ties into maybe your oil refinery play. Are there any energy names, John, that you think will be important to support future infrastructure growth?
Well, we've talked about this one multiple times, right? And you can come onto our investing page and you can look under power and infrastructure, um, and you will find a lot of energy companies and energy plays. So I'll just leave it at that. Okay.
All right. John, we got a question about Bitcoin. Obviously, Bitcoin's in the news huge over the last couple of days. The question was, John, are crypto Bitcoin blockchain stocks correlated to the equity market? And it's an interesting question because on a very recent show, John, you said that Bitcoin was correlated, I believe, to the NASDAQ 100. So do you think that rule or that train of thought also applies to cryptocurrency stocks?
Well, I think what companies are in the NASDAQ, right? I mean, like Coinbase and what are some of the other ones? MicroStrategy
MicroStrategy,
and
yep. Block
Block,
SQ,
right?
yeah.
Right. So what we see is that there's a huge correlation between the Nasdaq and Bitcoin, and those companies that you just asked about crypto related companies, they're in the Nasdaq. So I guess this is the old, if A equals B, then B equals C or something like that, right?
Yeah, I mean, I think they're all pretty well correlated. I mean, the
Yeah.
crypto stocks are correlated with Bitcoin, of course, and then if you believe that Bitcoin is correlated with the Nasdaq 100, or let's just say the riskiest of the tech stocks, then you would assume that crypto stocks are then correlated with the overall
Right.
equity market. I think there is a tie-in with all of these names.
No,
The
if
other,
there was something adverse would happen, I would think that those companies that have a direct relationship to Bitcoin are going to have a more adverse reaction to a reversal in Bitcoin prices, or maybe even positive Bitcoin prices. But overall, I still believe that Bitcoin is just another tech type asset because of this relationship to what goes on with the Nasdaq.
We got a follow-up question here, John. If you have any thoughts on stable coins.
Well, this is really your arena, and what you've told me, and taught me is that stable coins. There's this trend about how stable coins um, have a greater value because of some regulatory issues that are coming up, either of just recently passed or coming up this next week, right?
Yeah. So we've got the Genius Act, right? That the U.S. Congress is trying to pass through that will legalize, put together a regulatory framework for stable coins. Now, stable coins I think are going to be a huge thing in the future, John. As far as an investment, I'm looking at the ecosystems where those stable coins are being built on top of. So those are mainly Ethereum, Solana, and Tron. So those are kind of the three names, John, that if you really want to sort of make an infrastructure bet, right, on the future of, let's say, U.S. monetary policy, I think those three have potential from an investment perspective. Now, from an economic perspective, and this is something that Treasury Secretary Scott Bessent has said, there's a concern about, waning foreign demand for U.S. treasuries, right? U.S. dollar, right? A lot of people are saying the dollar is dead, it's over. But Scott Bessent says that stable coins, John, will increase demand for the U.S. dollar, right? Which makes a lot of sense to me because those are backed by U.S. dollars. They will be backed by U.S. dollars.
Well, U.S. Treasuries. There'll be more demand for U.S.
Treasuries,
Treasuries as a safe haven that will be the backbone of these stable coins, right? Do I have that right?
You do.
Okay.
Yeah.
Okay. So listen, again, full disclosure, I'm not a big crypto person, but I'm forced to have crypto as part of my portfolio. So this is the one crypto that I have and this is a ETF that not only takes into consider Bitcoin, this is a largely weighted Bitcoin, but it also takes in consideration the 10 top market cap cryptos. So if you're interested in this space and you want to be diverse in that space, this is a way that you can play it. Again, full disclosure, this is a stock that I already hold. And if you look at this one versus what we compared it to, what the Bitcoin is, this looks like a lot more stronger stock, or at least chart, than what we've seen recently in Bitcoin. So just take it as it is.
Again, a couple more follow-ups since we're on the crypto. Sorry, John. Is there a volatility index ticker for Bitcoin? I do not believe so. None that I'm aware of. Again, you could go. We do have the Nasdaq 100 volatility index though, so you could look at that as sort of a proxy, and then maybe just add a little bit to it to sort of maybe come up with a synthetic volatility for Bitcoin.
Yeah, I think also you could go to the CME group, and I don't think we have it on our page, but let me just double check. Under the currencies here. Yeah. There it is, Bitcoin Micro. So that's a way you could play the little bit of the volatility is through the futures contracts. So.
And then the other question was about tokenized stocks. Again, tokenized stocks is not something I've taken a close look at, although I'm hearing a lot of people talk about this. Robinhood is talking about this. There's a lot of talk in the Solana ecosystem, John, about tokenizing stocks, which would then allow, it's not really a big deal for us, John, because we have easy access to U.S. stocks in our brokerage accounts. But if you're overseas, right, and you want to make an investment in Nvidia or Microsoft or Apple, maybe it's difficult for you to get your hands on those stocks. So tokenizing them in this way would actually maybe increase demand for those stocks, John, for people who maybe ordinarily wouldn't be able to get their hands on it. So that's just my one kind of thought on that.
All right, enough of the crypto space, my friend.
Hey, man, we got to give the people what they want. So today is a crypto day.
Everybody wants crypto.
All right, let's see. So we got a follow up from Vic here, John. He asked, I think, a pretty good question. Has to do with unusual options. Mm-hmm. So we generally look at volume, right, John, for unusual options to maybe spot deviations in the market. But he's saying, wouldn't it make more sense to focus on options that show an increasing open interest rather than just looking at one day's volume?
That's a great point. But the problem with open interest is that I definitely would, you want to see volume. You want to do a kind of comparison of the two, right? You want to look at volume as it compares to open interest. That's how this page is created, right? Our unusual options page, right? We want to see this large amount of daily volume. But to his point, I think is this a 1 day event? Could this be a DTE kind of thing, a zero DTE? So, unfortunately, you will not see open interest change on the day of the volume. You have to wait for the following day. So, the Vic's point is, I think what I would do is if I'm looking at an unusual options trade today, tomorrow, what I want to see, for instance, in this one here, am I going to see the open interest go up? And how much does it go up by? For instance, the volume here is 12,400. So if let's say the open interest tomorrow goes up to like 11,000, then I think that takes more onus to whatever that option activity was. But if the option only goes up maybe by 1,000 or 2,000, well, then it's probably just some day trading activity. So yeah, I think that's a great way to look at unusual options in terms of the relationship to open interest. I think I have explained that question. How do you think of that?
Yeah, I think so, John.
Okay.
So I guess there's another follow up to what you just said, John, and it's about how can options volume exceed open interest? I mean,
Well, so here's the idea, right? Open interest is a value of contracts that remain open. In other words, it takes two parties. You have a buyer and a seller, and they come together and they create a contract that creates open interest. So volume is just a reflection of all these transactions on a day-to-day basis. So what happens is every day we create volume. Some of that volume is based on somebody who is closing a position. Some of the volume is somebody who's opening a position. Some of those are going long. Some are going short. So when we see open interest rise, that's telling us that we're seeing a lot of new positions. So if we see a lot of open volume and we see open interest go down, that means that they're closing positions. So volume is just the precursor to open interest. Does that make sense?
it makes sense. And if you guys are having trouble wrapping your head around it, just imagine a new option, John. It gets listed, right? The open interest is zero, but
Zero,
you
yeah.
can go out there and you can buy it. That's a volume. You can buy one contract. That's volume of one. Then the open interest will rise, right?
Raised by one
Yeah,
and remember, you can't buy it unless somebody sells it to you.
exactly.
So an open interest represents both, and this is the really important point. Open interest represents both a buyer and a seller, and not both a long and a short. Okay.
We got a question. So we don't usually take questions on symbols that we haven't talked about, John, but I'm just curious if you've ever looked at the U.S. Aerospace and Defense ETF.
Do you know what the symbol is? Is
Symbol
that
is ITA.
I usually look at like I think the one that I've been looking at is missile or something. I forget. ITA.
ITA, yeah.
I mean, they're all basically the same, right? And it's just it depends on what you want out of it. I've been kind of looking at at this space, but I was thinking more going outside of the U.S., looking at some European ones. But anytime you look at an ETF, it's really important that you go and look at their constituents or their makeup to make sure that are the stocks that you want to be part of. And if I gave you the top 5 or top 10 aerospace defense companies, I mean, there they are. I mean, you couldn't ask for a better representation. So there's my answer. Right.
Um,
I
John
worry
would,
about this though, right? I worry about one
uh,
stock having a large, or that your top 10 having, a line share of. I'm more
yeah.
like I like a lot of equal weight kind of type ETFs, but
Yeah, I mean, you've got more than 1/3 of that portfolio in two individual names. So that's maybe a risk tolerance question that somebody would have to answer for themselves.
right. So here you can see missile, right? Same mix, but you get a little bit of better spread out. And I think the other one is, I think it's Spear. No, I'll look it up. Missile, but you can go into our ETFs, finder, and you can search for that. Okay.
We got obviously silver. John has been on an incredible run, highest price in about 14 years. So we got a question: if you would look at the 2x levered ETF, which is AGQ, would you look at that ultra silver ETF?
I'm not a big leverage ETF, especially in like what's the symbol again?
AGQ.
AGQ. So here's the reason why I'm not. If you believe in momentum and you're looking for, to leverage momentum in a very short period of time, then yes, leverage EVT ETF is fine. But there's the way the ETF trades or how it creates this leverage. You get what is kind of like what's called a volatility dump. In other words, like a negative dividend. In other words, you could have multiple up days and get that leverage, but then you have one bad day, and that could take back the whole, you know, gains that it have. So, very short term. If you're going to trade this, it's just really this is a substitute for trading the futures contract. I would rather see you trade in the futures markets or in some of the micro contracts because these are not good tools for long term investing or even for long term or medium term momentum trading. This is a really tools to use for like 1 or 2 or 3 days at the most because of this volatility dump, what happens, how they have to reprice on a day-to-day basis. But again, look at today, right? It's up 7.9%. And what did silver do today, right? So I'm going to tell you what silver probably did. That's energies and energies. I want metals. Silver is probably up 3% today, right? Because it was a 2 times leveraged ETF. And so let's just check and see what silver did today. Oh, it's up 4%. Okay, so 5%. So you really didn't get that 2x leverage. So again, another reason was I'm not a big fan of leverage ETFs.
John, do you only use risk reward calculations for options, or do you use it for others?
Yeah, no, all my trading, I mean, Thomas kind of picks at me sometimes with this, is, I always look in the market from the lens of risk. One of my tutors was, no pun intended, is Paul Tudor Jones. And he always looked at a trade from what is my risk? What is my risk? And so that's the way I always look at a trade. So yeah, I always look at the risk to reward relationship to decipher how I want to take trades or how I price how I want to pay for trades.
So, John, you talked about materials. Is that your favorite sector right now? Because we got a question about sectors you're looking at.
Yeah, I think it has been one of my favorite sectors. Because I do believe in this cycle of sector rotation. And again, not a lot, it doesn't always happen that way. But when you see the evidence, right? And Thomas, stop me if I'm wrong. I think more than 2 months ago, we identified that there was a shift in momentum in these sectors, and that again, let's look at this from a perspective of since, what was it, Liberation Day, right? Let's go to that low, right? Cyclicals have been, technology has been the best, but look at there they are. Industrials have been one of the outstanding sectors. Materials are just starting to catch up. But what could drive materials, right? This idea that market's always looking forward and that next year we could see, lower interest rates. I think this could be good for corporate earnings, right? Might see something in economic growth, lower interest rates. When we see the housing market starting to, regenerate. So I think there's a lot of positives in the material space. And certainly we've looked at a couple candidates, copper and refined products, that are evidence of that.
We got a question, John, about any macroeconomic influences that you think could have an impact on the market coming up. I mean, the biggest one for me, John, is the September FOMC, because that right now is when the market is expecting the Fed to begin cutting rates. We've got about a two-thirds chance, John, the market is currently giving for at least a 25 bips interest rate cut. I think that right now is where the market's eyes are, and trying to get a read into Powell's mind and the rest of the Fed's minds.
Yeah, I mean, there's even an outside chance, and this is something we've kind of looked at before. Is there is an outside chance that we might actually see a cut this month? Now, I've maintained that I think we're only getting one cut, but I could make a case that if we look at interest rates here domestically, and we look at, let's say, the short end of the curve where the Fed can control, and you look at their rates, 4.3, 4.4, 4.3, 1 3 month, and then you look at 2-year, which is 3.9. This is really telling me that there is still this tightening of liquidity. So this could be something that could happen sooner than later, this inverted yield curve. In other words, that the Fed really is behind the curve. If they want, they have, the market is giving them permission to cut rates. So what they've been holding back on is the idea is what is going to be the effect of tariffs, right? And I know we're kind of sick of talking about tariffs. So, the problem is we keep getting this deadline gets pushed farther and farther into the future. But we do get a lot of evidence from a lot of corporations that are saying that some of them are saying that they've already priced in tariffs into their earnings, and others are saying, hey, yeah, this is going to be inflationary for us. So I think those two things, the next Fed cut, when it comes, does it come in July, does it come in September, or does it come in December? And the actual effects of tariffs. I think those would be the two macros. Underneath the market, though, I am watching employment, and I thought what was interesting this week was the government stat showed employment was holding steady. It was a little bit lower than expectations, but ADP, which I kind of look at more reliable, which is more of the private sector, it actually fell. So again, that might be a statistic that will allow the Fed to cut sooner than later.
All right, guys, we've been going for about 50 minutes. So, John, let's do one final one, and I'm going to give you the choice because they asked about two of our favorite stocks, either Google or McDonald's. They want your thoughts on either one of those. They said McDonald's could be forming a cup and handle. They said Google could be approaching a triple top, which I do see on the chart. So, John, I'll let you pick your favorite of those.
I'm always a fan of McDonald's in terms of trading this one. So I do, I have my McDonald's Chick-fil-A index, and I haven't really noticed any change in activity around it. But, it is getting back to the 200-day moving average. But to me, again, I'm not a fan of McDonald's until it recaptures the 200-day moving average, and I want to see it outperform the S&P. It's not doing that. What was the other one? Google. Well, Google is there's just so much around Google right now, right? Potential that it might be broken up, it might be worth more if it's pieces. I keep reading all these kind of things that Google is coming up with. I was just reading they came up with they have an updated AI version of medical AI that now can read your transcripts, your medical transcripts, or look at your X-rays and give an accurate reporting, diagnosis of your report of about 84%, which is about what humans do. So, I mean, I just think there's something about Google, right? This is kind of be like the Skynet of the future, right? So I would not discount Google, right?
Yeah, I have a pretty good sized position in Google. I'm not looking to exit. I might even be looking to add, but the one thing that really jumps out at me, John, is how far off its all-time highs it is when others are at or above. And so you could look at Google, John, as maybe, I know this is going to sound really strange to say, but maybe it's a value play within the actual Mag 7.
I think it is. I think you nailed it on the head. You got a nice rounding bottom. It is starting to outperform the S&P. It's above its 200-day moving average. It looks like it's broken out of a most recent level of resistance, a 4-week level. So, I mean, and if they do break it up, it's probably worth a lot more in the different units than in the whole. All right, let's leave it at that, Thomas.
Let's do it.
Folks, thanks for joining us. I hope that you guys got something out of today's show. I appreciate Tom and I appreciate you being here with us. Until next time, the bet the how, manage your risk, and the good of all trading.